So we'll start the discussion on the monetary policy and financial markets, followed by a discussion on the fisc, before we turn to our discussant to get a point of view. Yeah.
Welcome back. So now we shift gears and talk about monetary policy and financial markets. So first, looking at the trajectory of the policy rate, we know that there was a long period of prolonged monetary policy tightening starting from May 2022, and then there was a prolonged period of status quo in 2023. Now, in this calendar year, 2025, we have seen two instances of monetary policy easing. The policy repo rate was reduced from 6.5% to 6.25% in February, and further from 6.25 to 6% in the April policy meeting. And more significantly, the stance, which continued to remain at withdrawal of accommodation for quite some time from 2022 till the beginning of 2025, we saw the stance changing to neutral in February and further to accommodative in the April policy. Now, April policy was announced on 8th of April, so it does take into account some measure of the impact of Trump shock. There is some discussion in the monetary policy statement. By implication, due to the reduction in the policy repo rate, we saw that the short-term money market rates are also trending down. The call money rate, which is the red line, it has reduced to 5.67% as according to the latest April number. Now, given that we have an accommodative monetary policy, we do expect that the rate cut cycle, which was earlier expected to be more shallow and short-term, could be more deeper going forward, given that the stance has changed from neutral to accommodative, and also given the fact that in the April monetary policy review, the growth projection was also revised downwards by 20 basis points for FY26. Inflation projection was also revised down. So clearly, at the moment, the focus of monetary policy seems to be on supporting growth rather than on inflation. We saw in the previous session that inflation is likely to remain contained, and even as per RBI's own projection, it is 4%. Our projection is still lower. So overall, inflation is not a cause of concern. And the other important factor here is also, if we look at the IMF World Economic Outlook, it says that the commodity prices are expected to trend downwards, particularly oil prices, and that would also have a bearing on the monetary policy outlook. And therefore, clearly at this moment, the focus of the policy is on supporting growth through policy stimulus. Also, if we look at the what's happening to bond yields, and that has implications for FPI flows, that has implications for exchange rate, and so on. So what we see, if we look at the left side of the graph, this is government bond yield across the various tenors. So we see 1 year, 3 year, 5 year, and 10 year bond yield. All the bond yields are showing a downward tendency, and there are various factors contributing to this. One is certainly the easing of inflation, monetary easing, and also that in recent past, we saw that the government Indian sovereign bond yields have been included in the emerging market bond index. They have been included in the JP Morgan bond index and lately in Bloomberg index. So there is a bunch of passive foreign investment flowing into the bond market, and that has given an impetus to demand for bonds, and therefore bond yield is trending downwards. But if we look at the corporate bonds, we get a mixed picture. Mostly the bond yields are trending down, but for some tenors, the 10-year bond yield has, 10-year corporate bond yield has risen. Now, there could be various factors. One factor is certainly that there is, because this is nearing the end of the financial year, there's greater supply of bonds, and therefore the bond yield has ticked up. But also there is also a possibility that there is greater access to the bond market to raise finance, and that could possibly be an early indication of private investment. We also see various signals of private investment. We get mixed signals. It's not a very clear-cut picture. Various indicators present a mixed signal, and this is one indicator which is again portraying to something mixed, where for some tenors it's showing a downward trend, but for some tenors it's showing an increase. So we need to see going forward how the trajectory pans out once the implication on the external challenges is also a bit more clearer. Coming to the banking sector liquidity, we saw that there was a period, if we look at the FY25, there was a period from July onwards when the liquidity was in surplus. Then there was a period, December, January, when liquidity turned into deficit. And this is monthly data, which actually conceals the impact of several spikes of very high liquidity deficit in certain time periods and certain episodes. But mostly there was this period of liquidity deficit. And then from the beginning of this calendar year, January 2025, we've seen that RBI has taken a host of measures to infuse liquidity, like reduction in cash reserve ratio, engaging in open market bond purchases, USD INR buy-sell swap in recent months, and all of that has resulted in liquidity surplus. The other implication we must know in related terms is that this was the period when the liquidity was in deficit, was also the period of aggressive intervention by Reserve Bank in spot market, which resulted in sucking of liquidity, and that also had implication for the liquidity deficit emerging in this period. And now we have seen that the scale and pace of intervention has considerably narrowed, and that is also reflecting in the liquidity surplus. But overall, it's mainly due to the host of measures that have been taken to infuse liquidity, the variable repo auctions, open market purchases, the USD INR buy-sell swaps. All of that has resulted in infused liquidity, and even in the latest monetary policy statement, the RBI focused on maintaining a comfortable liquidity position because that has bearing on the credit market also. The other important part to note here relatively is that when the credit demand is muted, banks tend to park their funds with the RBI. So the SDF balances has also increased in recent months. So that is something we need to see whether SDF. Yes, so standing deposit facility, which is the lower end of the LAF corridor. So when the credit demand is muted, and therefore that's our next graph, when the credit demand is muted, even though there is liquidity, if there is less of credit demand, then banks tend to park funds in the standing deposit facility, which is parking funds with the Reserve Bank. So we see that in the recent few weeks, there has been a sharp surge in SDF balances. But now coming to the credit trajectory, we saw there was a sharp surge in bank credit growth, particularly in 2023, where the non-food credit growth, which is the black line, was above 15%, and that was mainly driven by two important drivers of credit, which is personal loans and services. Personal loans is the yellow line and services is the green line. In services, the main component is the loans of banks to NBFCs. So that was the key driver of bank lending. But during this period, when there was a prolonged sharp surge in loans to personal loans and services, there was also these concerns that the unsecured personal loan is rising, and RBI came up with regulatory prescriptions in the form of increase in risk weights for banks' exposure to unsecured personal loans and banks' exposure to NBFCs. That was introduced in November 2023. But its impact started to be felt in the second half of 2024. From June 2024, we see a sharp decline in personal loans and also in services, which resulted in a decline in overall non-food bank credit. Now, the non-food bank credit, which was quite high, it's now closer to 11 to 12%, and the projection for this year is also that it will hover around this range, 11 to 12%. Notably, because credit growth has slumped, the regulatory prescription that was introduced in November 23 has now been reversed partially. The risk weights that was introduced for unsecured personal loan has been taken back, but the risk weights on NBFC still remain in effect. So overall, we see that there is a decline also, but if we look at industry, loans to industry, there we do not see much traction happening. So the two sectors that were driving growth were personal loans and services, and they have come down. Going forward, it is these two sectors that would shape the trajectory of non-food bank credit. If we compare credit growth with deposit growth, now here we have two lines for credit growth. We have the red line, which is the credit growth excluding the HDFC merger, the yellow line, which credit growth including the HDFC merger. The trajectory is more or less similar, but what we want to show here was this period of big differential between credit growth and deposit growth. Because driven by very sharp growth in non-food bank credit, but the deposit growth has remained more or less stable, and it plummeted during this period. But now we see that the differential between credit and deposit growth has significantly narrowed, and that is something that will have implications for banks' balance sheets going forward. It will have implications for net interest margins of banks going forward in FY26. It will have implications for monetary policy transmission going forward, that now the rates are being cut, whether deposit rates will be cut, given that deposits are already stagnating. So these are something that this graph is important from that perspective, that given the monetary policy transmission, will we see a complete transmission happening given this trajectory of deposit and credit growth? Coming to markets, we see that markets have staged a recovery in the month of March. Overall, if we look at FY25, we saw that markets have remained volatile. The right-hand side graph shows the Nifty 50 market returns, monthly data. There were periods of decline, and then the last 2 months we've seen positive returns. And if we look at cross-country experience, we see that Indian markets have fared quite better as compared to some of the other markets. Looking at FPI investments, they have remained volatile, understandably so due to the uncertainty on tariffs, weakness in dollar. There was this period where FPI investments in bonds was rising more than equity, particularly this March period, where this positive trend is mainly because of FPI investment in bonds. But now, given that Indian bond yields are declining, as we saw in the previous slides, and the US bond yield are rising, we are seeing again an outflow of FPI investments from bonds to the US bonds. So that is something that will shape the trajectory of the FPI net investments going forward. But as of now, we see that overall there has been some level of recovery in markets, but FPI flows tend to remain volatile. Thank you.
Before we move on to fiscal, I just want to ask one small question from you. So the monetary policy stance has now changed, not only to neutral but accommodative, and everything has been moved in that reduction of rates, liquidity becoming surplus, etc. And in that background, 1 month we saw the FPI coming in, but during this period, the whole FPI has been flowing out. It is the typical thing of flight to safety, but as you mentioned in the previous comments, that the flight is working in reverse now. The FPI is running. Dollars are running away from the US market. What do you think going forward? What's going to happen? Are there Because they only account for 17-18% of the market.
Yes.
But because they work like a herd, they drive the market. So what do you think is likely to happen going
What
forward?
we see is that, if we look at particularly FPI investments, and there is also very interesting data on sector-wise FPI investment, there we see that there is a churn happening in FPI investment in sectors. Earlier, FPIs were investing mostly in financial sector, services, banks, but now we are seeing that they are investing in those sectors which are insulated from external shocks, like consumer sectors and so on. So there is a churn happening. There is a churn happening not only in the FPIs, but also in the Nifty. What is driving the Nifty returns is different from what was driving it earlier. And this will be going forward, be shaped by the trajectory of dollar, and it will be shaped by trajectory of the US bond yields. Currently, we are seeing a weakness in dollar, and that will have an impact on FPI investments. There could be periods of inflows in equity, outflows in debt. So overall, there is this period of uncertainty, but sector-wise, there is a lot of interesting churn that is happening both in FPI as well as the key drivers of markets.
Now, fiscal part.
So let us now look at the fiscal outlook of the governments, central and state governments. So here what we do is we examine the various fiscal indicators of both the union as well as the state governments during the fiscal year 24-25, that is for the period April 24 to February 25, and compare it over the previous period 23-24, and then also look at the budgets of all the state governments and the union government and see what have they estimated or projected for the year 25-26 as compared to the revised estimates for 24-25. So let us first look at the revenue side of the central government. So this is the column that we are focusing on, April 24 to 25, February 25 vis-a-vis last year, the year-on-year growth. So we find that the gross tax revenue of the union government grew by 11% during this period. And this growth was led by growth in income tax, which increased to by about 22%. CGST growth also was buoyant during this period at 11%. But what we observe is a sharp decline in corporate tax growth due to fall in corporate profits during that year. Excise duty continued to decline, and customs duty growth was moderate at 4%. So that is the overall picture on the revenue side. But in 25-26, the gross tax revenue growth target is set at a modest 10%. And as compared to, if you look at what the nominal GDP growth is projected at 10.1%. On the non-tax revenue side, we find primarily due to increased or enhanced dividend from RBI, you find a very high growth in non-tax revenue. But going forward in 25-26, it's projected to increase by just 10%. It should be noted that the budget came in 1st February 25, and it was prior to the Trump shock or the Trump presidency. So the actual, as the things are developing, as my colleagues Radhika and Rudrani had discussed about the possible impact, the projection or the estimates for 25-26 may turn out, on the revenue projections may turn out to be significantly lower. So we'll have to wait and watch and see what developments happen and then how it impacts the revenues of the central government. Moving to the expenditure side, we find there is a sharp contraction in capital expenditure of the union government. Growth of capital expenditure contracted sharply, and which enabled union government overshooting the FD target, basically more than meeting the fiscal deficit target that was set in the budget. So if you look at the subsidies, major subsidies, food, fertilizer, and petroleum. In 24-25, it remains at the same level as it was in 23-24. In fact, there was a modest growth in subsidies of less than 1% in 25-20 compared to a 21% fall in the previous year. And this is despite the fact that the government in last year announced extension of free food grains under Pradhan Mantri Garib Kalyan Anna Yojana in 24. So despite that, you see that subsidy levels have remained more or less similar to what was in the previous year. Capex growth fell by less than 1% during April-Feb 25 compared to 36% growth in the previous year and 21% growth in 22-23. So the story is there is a sharp contraction in capital expenditure growth of the union government. For 25-26, the capital expenditure is budgeted to grow at 10% compared to a 6.7% increase in revenue expenditure, and major subsidies are budgeted to remain at the same level. Now coming to the fiscal deficit, 24-25 FD target of 4.9% was met, mainly due to sharp contraction in capex growth. And in 25-26, the target was set at 4.4%, lower than the earlier reduction goal of 4.5% by 25-26, which was announced by the finance minister in her 21-22 budget speech, where she said that by 25-26, the target of, they did not announce year-wise target, but a terminal year target of goal of achieving 4.5% FD in 25-26. So that has, so in 25-26, they have budgeted for 4.4% FD. Now, there was another important shift that happened in this budget, though it was announced in the budget for 24-25 final budget, but the modalities were spelled out in this budget was the 25-26 budget shifted to a new fiscal consolidation framework with debt GDP ratio as the key monitoring target. As you know, debt to GDP ratio is less sensitive to change in fiscal deficit compared to fiscal deficit to GDP ratio. An increase in fiscal deficit ratio would mean a substantial digression or substantial breach of the FD target, but similar increase in FD will add the impact on debt GDP ratio would be marginal. So by moving to this new anchor, it gives more flexibility to the government for fiscal management within the new fiscal consolidation framework. The government announced a new fiscal consolidation roadmap for the period 26-27 to 30-31, basically for the award period of the 16th Finance Commission, with debt GDP as the new fiscal monitoring target. The aim is to set fiscal deficit each year such that debt to GDP ratio gradually declines to or a ratio of 50 plus minus 1% is attained by 31st March 2031. That is the terminal year of the 16th Finance Commission award period. And this framework gives we think this framework will give more elbow room for increasing capital expenditure, which we saw have fallen in last year, to revive economic growth. Now, let us now move to the finances of the state government. So you find that similarly, here also we examine what has happened in 24-25 vis-a-vis 23-24 and what all states in aggregate have budgeted for 25-26. So you see that total revenue receipt growth, which was around 10.3% in 23-24, has now fallen to 6.4%. And of the total revenues, receipts of the state government. 64 in 24-25, 64% was from the own revenues, which is the own tax and own non-tax revenue of the state government, and the share of central transfers, which comprises devolution recommended by the Central Finance Commission and central grants to states, was 36%. If you look at the own tax revenue, which is the dominant component of the own revenues, accounting for about 88% of the own revenues of the state, its growth, again, we see it fell from 11.2% to 8.6% in 24-25. But there are large large interstate variations ranging from negative 2% in Telangana to about 24% in Assam. And in the budget for 25-26, all states have budgeted the own tax revenues to grow at 14%, and and the employed buoyancy is greater than 1, given that the states have budgeted the GSDP on average to grow at 12% in that year. Now, given what has happened in 24-25, or we feel that the assumptions of our state projections are unduly optimistic. So you see own revenue growth increased, is projected to be at 14.5% compared to 7.8% what was achieved in 24-25. Own tax revenue, again, from 8.6%, you are projecting it to grow at 4%. Own non-tax revenue from 2% to about 17%, and central transfers from little less than 4% to about 8.7%. So all these estimates we feel are unduly optimistic, and GDP growth projection is also optimistic at 12%. Let us now look at that is what states budget indicate, and we find that the quality of fiscal marksmanship is the issue. States budget something, revised estimates come out to be totally different, and actuals are very different. And many times what we see that state budgets revenue or such a way, or inflate the revenues, or compress the expenditure to show that we are adhering to the FD target, but when it actually happens, it might turn out to be very different. So that is what we are saying, that it is nowhere near to what the real picture that is emerging. So that's why we suspect that it is very unduly optimistic, actually. Now let's look at the central transfers, which comprise of devolution and grants. So we find that decline in devolution growth along with further sharp contraction in grants. So that's the story on the central transfer side. So central transfer in 24-25 grew by less than 4%. Although there was an increase of 15% in devolution on average, but it was largely offset by decline in grants. So you see devolution growth was 15%, whereas grants fell sharply by 22%, which meant that the overall central transfer growth was just 3.9%. And then going forward in 25-26, we find that the states have budgeted devolution to increase by 10% and grants by 5%. So so this is on the central transfer side. Let us now move to the expenditures of the state. So expenditure growth of the states is driven by revenue expenditure, and while capital expenditure contracted. So we find that during April-February 24-25, combined capital expenditure of all states contracted by 2.1%. So in the union government side, you find there was a contraction, and at the state level also you find there is a contraction, and this contraction is despite 1.5 trillion 50-year interest-free capex loan provision from the central government in this current budget. So, and then in 25-26, the capital expenditure is budgeted to increase by 15%, and which we feel again is unduly optimistic compared to a negative a contraction of 2% in 24-25. Revenue expenditure growth of was 11% in during this period, and which largely accounted for the growth in total expenditure. We see there was large interstate variation in revenue expenditure ranging from 4 to 23%. And in 25-26, the revenue expenditure is budgeted to be increased by around 9.2%. Now let's look at the deficits and the liabilities of the states. So states fiscal deficit is back on consolidation path. So the fiscal deficit, which is the orange line, which was around 4.1% in 2021, due to COVID, it increased. So it improved to about 3%, and then there was a minor dip in, or the fiscal deficit increased to 3.6% in 24-25 revised estimate, but 25-26 we see it is back to the fiscal consolidation path. But while in aggregate states are adhering to the fiscal consolidation path, there are some states where the fiscal deficits has been extremely high, and these are 12 states where fiscal deficit has been in 25-26 have been budgeted to be more than 3.5%. Andhra, Arunachal, Assam, and so on. And if you look at the second graph, which shows the outstanding liabilities, it is around hovering around 28-29% of GSDP. And if you look at what the fiscal glide path, which is the orange line of the 15th Finance Commission, states are well below the fiscal consolidation path recommended by the 15th Finance Commission as far as outstanding liabilities is also concerned. And this shows the combined position of center and state, so general government. So this general government is also, or the combined, so it's continuing. So combined fiscal consolidation of center and states continues. So this is the fiscal deficit, and it is decreasing as, but although it is below the glide path recommended by the 15th Finance Commission, but still it is moving towards that direction. And as far as the liabilities of state and center and the general government, it is well below the prescribed path of the 15th Finance Commission. So overall, we find that both, so combined government, the fiscal consolidation continues. Now, what would be the likely impact of the global disruptions that is happening due to Trump tariff and so on? So as my colleagues had pointed out, that we all believe that IMF's growth projection underestimate the impact of both global and India's growth. And if one factors in the disruptions due to major policy changes in the US, including massive shrinking of federal government, the impact on global growth and India's growth would be much larger than projected. And such impact on GDP will affect the revenues of the union government. And a recent episode would, if you were to compare with a recent episode, would be the global financial crisis of 2008-9. We are not saying the impact would be of that level, but to give you what could be the likely impact, what happened during that time would be, so you see that the union government's revenue growth fell from 24.7% in 7-8 to minus 0.3% in 8-9 before rebounding to 6% in 9-10 and 37.6% in 10-11, thanks to strong monetary and fiscal stimulus. So the impact, the likely impact on GDP growth of Trump tariff and the impact would call for appropriate fiscal and monetary stimulus within the new fiscal consolidation framework. So, situation is still emerging. But this gives you an idea as to what happens in case of in case of a major disruption. We would have to have we have to take appropriate fiscal policy as well as monetary policy stimulus measures to revive growth. I stop at that. Thank you.
Shoja, with your permission, before we go on to your comments, just a couple of things to summarize the takeaways from Manisha's presentation on the fiscal side. First, on the states, one thing we noticed, as we brought out very clearly, is that they're very unrealistic in all these, optimistic projections or revenue and so on. And partly, as he implied, this is done to make the budgets look good, that they're complying with, the fiscal deficit targets and so on. But then when you see the actual revised estimates, you find that they, just violate all of that. But the other more important point that was there in his presentation is that when you look at central transfers, there you find that grants actually are going down, and even the growth of devolution, this is a formula driven by the 15th Finance Commission. But there's a way of bypassing that, or cheating, if you will, by just raising the share of cesses and surcharges. And as a consequence, even the growth of, transfers has come down. So the overall transfer position for the states is not looking very good. Coming to the other part, the overall picture, in particular central government finances, as he mentioned, the big problem there that we see has already happened is a very sharp decline in capital expenditure. It happened last year and is also there implicit in this year's budget. And this is all to make sure that they meet with the fiscal targets. I think this finance minister has a track record. This was a 7th or 8th budget. She's very firm to try and comply with that. But you're now in a situation, especially with the Trump shock and so on, that you actually need to revive growth, which has been coming down, as Rudrani has pointed out. So to do that, you really need to push capex, because capital expenditure public investment is a major determinant of your pace of growth. So it's no surprise that during the last 2 years, your growth has come down. Now it's going to be a bit more. So it is very urgent that capital expenditure be revived. And as it happens, they've shifted to this new fiscal framework, which is linked to debt rather than the annual GDP. That gives you much more elbow room in order to do this. And the FRBM Act actually allows you to do this. That if there's a shock, there's some unusual event, and they've invoked this also during the financial crisis, certainly during the COVID crisis, that this was invoked to get out of the FRBM limits and raise the deficit, in this case, in order to raise the capital expenditure and try and arrest the decline in growth. Decline will happen probably, but to try and arrest it. So let me stop.
We have with us Professor Sabir Sachikar, who is the director for the Institute of Economic Growth. No, I wasn't stuttering on the Institute of Economic Growth part, but since different institutions have different designations, I was stuttering on the designation. But very happy to have you here. We have had Professor Kar has been in the good old, bad old COVID days, a part of the NIPFP family. So we are very happy to have you back. We are also happy to have you back, perhaps for the first time on campus.
The second time.
Second time on campus. So very nice to have you back. We are looking forward to some stimulating conversation. I'm officially freaked out with the GDP and the inflation numbers because the FISC goes for a toss. But we are waiting to see what your take on the situation.
I think I need to correct you. I've been to this campus many times during my PhD, so I can't really say it's the second time I've come here. But anyway, I really don't have substantial comments to what has been presented because of the very thorough work that they have done, the team has done. Most of the expected outcomes I agree with. So I'll have a little bit of comment on some very specific aspects of things that the team has talked about. But most of my main comments will be trying to understand what's happening with this Trump thing. And I think there's a very important reason for forecasters to do that, which I'll come to. So just a few comments. One is, this goes back to what would be the growth rate in this year, particularly sectoral aspects. With agriculture, I understand that 6.4 is much more than what usually agricultural growth happens. But what I'm told by my colleagues in agriculture is that horticulture is making a huge difference to growth rates in agriculture. And so while 6.4 might be too high, we will probably be looking at higher agricultural growth rates compared to some of the past rates that we have seen because of this high value added part of the agricultural service. The second small comment is about services growth. Again, although the indicators seem to indicate that 7.5 was on an average a bit too high, but what we saw from your presentation was that a large part of services growth last year was the export-led services growth. Services did very well in export. So if we have a similar export performance, then probably services will again be able to grow at least at the rates that we've seen here. I agree very much with the inflation conclusions that you've drawn. Also, the thought that I have here is that the dumping angle is probably also going to be true for the agricultural and food sectors. And so that, in fact, provides even more optimism for inflation rates remaining low. So that's the point here. I'm a bit curious about some of these bond market outcomes and both the US and India. So I don't know whether anybody has an answer. I mean, I think the reason that bond yields were going up was bond prices were falling, and there were some reports that some countries were letting go of their bond holdings, and that's really the reason. Now, there are two related issues here. One is that is this just a strategic move and hence this is just a temporary kind of thing, or are US bonds really becoming or not remaining the zero risk, kind of asset that we have always thought them to be? And then if that does happen, then it's commonsensical to understand that investors will be moving towards some other, maybe bonds or other asset groups which they think are relatively less risky. And does that help the Indian bond market even in a very marginal way? Will there be higher bond holdings because of that? Is something we need to think about. Now, I really, those are mostly the comments I had. But coming to the bigger picture, the thing is, I've been doing forecasting for a very long time. And forecasting has one limitation, which is that it is based on past data and our understanding of past economic structures. The problem is we might be looking at a completely different kind of global economic framework in the future. And the best that forecasters can do is at least understand what is the kind of change we are moving towards and whether either in an ad hoc manner or otherwise make the models, reflect some of these changes that are there. Otherwise, we'll be restricted to kind of, forecasting based on similar, kind of economic structures that we've had in the past. So it's really fascinating to think about what's happening to the global economy. It's not only a fact that we are changing, but nobody seems to be sure of what direction we are moving towards. So just to point to a few things,
So when this whole Trump thing started, there were different explanations being given about what the objective of the US policymakers were. And I read about three very different reasons that were offered. One was that this was a revenue making objective, that, with tariffs, they'll get more revenue. We know the US has a fiscal problem. So, and on top of that, they're trying to give tax cuts to certain sections. So this will help from that point of view. Then there was a second explanation that this is the standard, developmental explanation of protectionism, that they have deindustrialized and they were providing protection to bring back industrialization. And then the third one, which is also doing the rounds, that this is basically for most countries, these tariffs are a way to get what Trump is calling deals, with striking deals with countries. The problem is that some of these objectives are contradictory to others.
Get the word.
They're deals that
deals.
Yeah. So we have to understand what the deals are, because that will define the world that we are going to live in. Now, on top of that, there are contradictions between them. I mean, if for example, you really do want revenue to continue, then you want tariffs to continue. But if you strike deals, then you'll be bringing down tariffs. So there are obvious contradictions. So one, I have been trying to understand what to make of all these various explanations. And is there a way to explain all these three different things in a one single framework? And here, some economists in the US, there's Oren Cass and there's Peter Navarro, some of these people who are trying to explain the Trump thing. And they have been saying a few things that I think are of interest to us to understand what's happening. It's possible that these three objectives that are being talked about are actually objectives in very different time horizons. So what these people are saying is that in the short run, the tariffs will be there, and so the revenue is a kind of extra this thing that they're getting, so they'll make use of it. It helps politically as well if you can give some tax benefits, etc. But it's in the medium run, basically, the objective is more the traditional developmental objective of giving protection to industries. And then the final thing in the long run, they are trying to change the existing global order in a way which all these deals will lead to. This is not to say that they will succeed. I mean, that all depends on a lot of things, but that's the idea. So what really is to understand it, it's best to start with the global order and go back to understanding what they're trying. So the post-Cold, not the Cold War, the Second World War, post-war, Second World War era has been a global order that has been set up by the US. And these had a number of characteristics, but two very important characteristics were that, or rather three, that the US is the global power, the hegemon, and it had both very strong economic strength and military strength. And in lieu of these two things, if you were a country which kind of were in the the US allies or group, you would get economically, you'll get market access. You could have excess, net exports with that country, which allows you to grow at rates which your domestic demand doesn't allow you. You get part of the US demand to fall back on. But this obviously meant that the US had to have a large external balance. Yeah, but as long as they were a strong economy, they would be able to do that. And the other one is a bit more, it's less economic and more geopolitical, is that we also provided you with national security. You see it's either against the USSR with the NATO, or later on maybe against China or Russia. So now what these economists are saying is that they realize that the US is no longer able to provide this. And so the changed global order that they want will have corresponding changes to, so the change, what are the changes? The first is that they have recognized that it will be a bipolar world. They have recognized that, they have to deal with the fact that China is going to be strong, both economically and militarily. In fact, what they're saying is that China is a far bigger adversary than the USSR ever was, simply because the USSR was strong militarily, but economically China is far more powerful. The second thing that follows is that the US is no longer going to be able to provide a market access to all its allies. And so they are going to move towards more balanced trade. They're going to ensure that they don't have as large a trade surplus that they used to have in the past. And finally, with security, what they're going to do is the security arrangements are going to be more balanced, with countries now having to pay for their so-called security much more than before. So it's a huge change that we are thinking about in the global order if all these things happen. And so it seems that the tariffs are not really tariffs at all. The tariffs are a way to try and change the global order towards all of these large changes that they are hoping to achieve. So if that's what the world is going to be, I think, from the Indian perspective, we also need to think in the short term and the medium term and the long term. And here, the outcomes that I see are very significantly close to what your team has presented. So the short term constraint is going to be, as long as these deals are going on, the tariffs are there, the main constraint on countries are going to be the market access that they will lose. Now here, I think India is in a slightly better position because we don't have that large a surplus for our economy, and we don't depend that much on excess or net exports for our growth as much. So yes, there will be some effect on growth to the extent that we will lose market access even more, but nothing like countries like East Asian countries or probably China, which had a very large market access. So this seems to be the short run effect. I mean, this is my reading. But moving into medium term, which is more 1 to 4 years or 5 years, I think what will happen is a huge amount of uncertainty that all of you have talked about. And this is going to affect largely through investments. And here I think India will be hit much harder, partly because our domestic investment, private investments are already quite weak to start with. So together with the global uncertainty, we're going to see a large hit in investments. And finally, in the longer run, if the US is actually able to pull off this huge thing that they are doing, then we are in a world where we may not have trade surpluses any longer, but we can still have larger trade relationships, especially given that there is a very distinct possibility of decoupling with China. And there, all these, things like the trade deal that we are talking about comes into play. So all in all, I mean, I think as Professor Mandal pointed out, there are pluses and minuses, but I think there's also a time element in it, and there are more minuses in the immediate, time horizon, but possibly more potential in the longer run. That's my take. Thank you.
Thank you. It sounds a little less dismal, I think. So that's helpful. But I'm sure there are people who have questions and comments. So we are now open for any questions and comments from the room. Yeah.
Respond to first his detailed comments and then go on. Collect everything.
Maybe we collect and then get back, if that is okay.
Fine.
Yeah. Or we can collect a few and then do that round. And so if there are questions in the room, in the two rooms,
Or will we do if there's somebody there?
Yeah, we have found a way to do it. So, okay. Anybody here in this room? Yeah.
So I would like to know the tariffs impact on the FDI toward India. How it's going to impact FDI in India, the tariffs.
Okay. Okay.
Introduce yourself, please.
Uh,
Because they're recording it.
okay. So my name is Gaurav. I'm PhD scholar in Delhi School of Economics.
Okay. Mhm. Anybody else has a question? Okay.
I have a question on the center state part. You said that,
Yeah.
okay, so sorry. I am Resham. I'm an assistant professor here at NIPFE. So you pointed out that we have moved from targeting the fiscal deficit to targeting the debt to GDP ratio, which is going to bring in more flexibility. And then you also pointed out that fiscal deficits, the debt to GDP ratio sensitivity to fiscal deficit is not as high. So that's the element of flexibility. So then what are the elements, what is needed to achieve the requisite debt to GDP ratio? Is that, so they have given a 6% target decline, almost like a 1% every year decline by 2030-31. So how is it, from where is it going to come, that decline in the debt to GDP ratio if the sensitivity of fiscal deficit is not as high?
Through GDP growth.
That's the only element left then. There's no other
Yeah, sorry, we'll get back. They'll
Okay.
answer. I should not. Yeah. So any other questions? Can you please introduce yourself?
My name is Rick. I work for Mint, the newspaper. Dr. Mandal mentioned that, capital expenditure is from the center is going to be key to drive up growth, considering the growth has slowed down in the last couple of quarters. But if you look at the capital expenditure, I mean, my essential question is, have we hit the ceiling when it comes to central capex? Because we have targets like you have to reach the debt to GDP at 50% by 2030. And also, as per the fiscal guide plan, 4.4 fiscal deficit target is to be reached by FY26. So considering all that, have we reached the ceiling when it comes to the central capex?
Okay. Yeah. Anybody else? Okay.
It's about the lending. So if I'm not wrong, we are doing a lot to promote industries. Then why lending towards industry is too low? And if we see past data, it's declining. And if I'm not wrong, saying like it's not going to rise anymore, if what I feel. So what could be the potential reason, and what all feel like, what kind of the future of lending toward the industries?
To your comments on the long run, short run impacts and medium term impacts. Yes, you're absolutely right. This kind of shocks cannot be just assessed in a just one time shock as it is, because so it's always this kind of shocks are required to get an idea of how much could be its impact over different periods of time. We need a integrated general equilibrium model with the India and the open economy with the US, the other party, and then how the world plays, and also like what the cycles, what's the impact on cycles, and what are the impacts on our long-term growth, and also you have to take into account what could be the policy stimulus if there are counter measures. So how the long-term growth will impact, but it's given that it's our main purpose of this meeting used to be the tracking the economy at a at certain period of time. So we really think about it, building something to look at this kind of knowledge, but at this moment we are just trying to look at that what could be the sort of a sure.
This is on the show.
Yeah.
Yeah. Okay.
On the question of bonds, that's a very interesting question, and a lot of developments are happening simultaneously. Even before the rollout of tariffs, a lot of things were happening towards de-dollarization, though it has not shown up its impact on the composition. If you look at the COFR database, which talks about the share of dollar in the foreign exchange assets, we don't see a decline. So again, the element of time comes into picture. Initially now, first let's look at what led to this upsurge in the bond yields. Again, there were a lot of explanations, whether it's driven by domestic holders offloading the US bond yields, or it's the Chinese and Japanese who are holding 1/3 of the US bonds. Are they offloading? It's not clear because it is it's going to have a mark-to-market loss for China. Also, it's not very easy to just go by that explanation that China has started to offload its US bond holding as a retaliatory measure to the tariff that was introduced, and therefore the bond yields have risen. So it's a combination of some offloading happening by the foreign investors and also domestic, and also the basis trade was playing its role, where hedge funds who had taken a lot of exposure, they were offloading because of the inherent volatility. So that's the short-term reason for the upsurge. But going forward, the tariff-related uncertainty, how the dollar will play, and also what is happening outside of the dollar, what's the role of Russia, China, and what's the role of gold going forward, that is going to have a deep impact, because we are seeing that foreign central banks are increasing the share of gold. Over the last 2-3 quarters, we have seen a significant rise. So all these factors will shape the role of dollar as a safe haven asset, and therefore the role of dollar-backed assets also. So it's a very, again, as you rightly said, element of time is very important. On the reason for why lending to industry is not picking up, the main reason is, as we discussed here, that private investment is still quite subdued. And unless there is a fresh demand and there is capacity expansion and capacity utilization of the existing capacity, there won't be demand for fresh loans. And it's very useful to look at the bank lending to industry in conjunction with the RBI's OBICUS capacity utilization data. And there we see that, we have not crossed the 75% mark. So unless the capacity utilization picks up by industries, by manufacturing sector, there won't be demand for fresh lending. And therefore, there was this period in 2008 where there was a sharp surge in bank credit, and that was driven by credit to industry and infrastructure. And then there was a period of NPAs, increase in NPAs. And since then, from COVID onwards, we have seen a lot of deleveraging happening, where industries have actually paid back their loan, and a fresh capex cycle. Though there are some early signs in some sectors, we do not see a broad-based pickup, and that is through a host of indicators. RBI comes up with this in its RBI bulletin. It talks about banks lending for infra projects, and there also we see it's more or less stagnant. So the picture is mixed on this, and therefore bank lending to industries has not seen a material pickup. That is one response to one of the questions. The other was, I understand, tariff impact on FDI. Now, before we get into the tariff impact on FDI, we should look at the FDI trajectory before that. And here we are seeing that in India, FDI is already moderating. It's not that the inflows are not happening, but there has been more repatriation happening. So as a result, FDIs are already muted in India. One reason is certainly the global slowdown, but also there's more of repatriation happening in the FDI data that is visible in some sectors. So that's the background that needs to be kept in mind when we talk about the tariff impact on FDI. Now, on the impact, it depends on what will be the hit of tariffs to the various sectors, and in response also the various deals that will be struck. If we are able to come up with some investment deal, then we may have a positive impact. Otherwise, it may be a negative impact. So as of now, it's very uncertain, but keeping the tariff impact aside also, right now, what is important for us is to have a look at the FDI data, the sectors which are, not getting an uptick in FDI in general, because that's the concern that's visible in our balance of payments data as well. So while tariff will have an impact, but the ongoing slowdown in FDI is something that needs to be looked through and arrested. Thank you.
Can I just?
I had a couple of comments on
Then-
I also have to respond. I'll start. So that's a very important and pertinent question that you asked. So if you look at the document, they just given the growth scenarios and the terminal year FD target. So debt GDP ratio from 49 to 51%. What is they were silent on the revenue buoyancy. They have not talked about what the revenue growth would be. And if you look at, and they are also, they say that it says that debt to, so it says that if FD aims to set FD each year such that debt ratio would be on a declining trend. So they do not also say what your fiscal deficit numbers would be. If you look at the last few years prior to the year where we were discussing, you find that the fiscal deficit targets were met largely due to buoyant revenue. So revenues were rising, and also that gave extra space for increasing capital expenditure. But in the last fiscal, the revenues were not that buoyant. The target has to be met, so it was met through contraction in capital expenditure. There was sharp reduction in capital expenditure. So going forward, I have not as of now worked out the how the path is, what would be the assumptions on the revenue side, what would be on the total expenditure, both revenue expenditure and capital expenditure. So by working out, we can see what the deficit would be if one were to achieve that 50% debt GDP ratio. Because see, if you see last few years, the expenditures were also declining because revenues gave you enough space to decline, to control for, or to control the revenue expenditure, and also gives you a space for increasing capital expenditure, yet keeping the deficit targets within meeting the deficit target. So they have not spelled out, so we can work out and see what it means in terms of reduction in fiscal deficit, what revenue buoyancy they are projecting. That has been silent. So it may so happen that the revenue, I'm just saying, but it may not be true, but the revenue buoyancy, they might have assumed much higher revenue buoyancy, or contraction in revenue expenditure would be very high. So one can easily work out. So the document is silent on, except growth, it's silent on every other parameter, and which actually gives them space to actually manipulate or maneuver to reach the number. So one can easily work out what would the deficit numbers look like, what would be the capital expenditure, what would be the revenues if we were to achieve that 50% debt GDP ratio. So they have been silent on that. Yes. Mike.
So I try to see what is the corresponding number every year. So it's not linear. So they are actually silent on everything except the target.
Just
so we
gave
don't know.
See that they just gave the terminal year number.
Right, exactly.
And the
And the
initial year. So
yeah.
you just they did a linear line they drew, but they didn't say whether you will follow that linear path or it would move in a zigzag manner. So
not linear,
so
for
it's just
sure,
that
but yeah.
they gave a target. That's it. Beyond that, so one can work
So
out.
every now, whatever they achieve next year is, consistent with their.
As long as they reduce the debt GDP ratio, reduction in debt
Right.
GDP.
Some
ratio.
reduction.
Some
also.
reduction, yeah.
We all know that debt can be brought down by inflation. Inflation. Now, we have an inflation targeting framework, that's fine. But if we are actually facing inflations that are lower than even our optimal, there might be a case for pushing up inflation somewhat.
So it just gives that terminal number, everything is silent. So it's up to the readers to decide how do we reach that, achieve that goal, what path to follow. So, and it also gives an opportunity to work out and see different scenarios, how it would pan out, it should pan out, and that target be achieved.
Thanks, Kavita. Since we have time, we've been doing very well. So I know I will respond to that. But before that, I want to say something about Shobhoshaji's excellent comments that you made, Shobhoshaji. 2-3 points I want to make. First of all, in this modeling, I mean, all of us who have played this game know that this is a big problem about modeling, that whatever model you choose, you're always using the past to project the future. And that's okay in normal circumstances, but when you reach a huge structural break, that everything that happened in the past is no longer a reasonable guide to the future, you have to go back to the drawing board and rethink what you're doing. And I just want to mention a particular anecdote in this context. We used to do this kind of thing earlier in collaboration with NCR. I was associated with them. Rudani would be doing. In fact, one of the models you asked about, Bornali is a co-author in that model. So when COVID hit that year, I mentioned to him we were about to come out with one of these things. I said, listen, Bornali, just forget about the model. It's no longer something that you can use. Instead, go and talk to your colleagues who, because NCR is of that type, they do a lot of these studies in different real sector things. I said, go and just have a chat with them and just make a judgment. Ask them to make a judgment. And then you aggregate and see what you get. And you won't believe it. We came out with the exact number of -24% for that Q1. And that was exactly what happened. I'm not saying that there was some jadoo we had, it's just coincidence. But here was a case where just this crude scenario building actually gave us a very accurate thing. And by the way, from what I understand, security establishments globally, defense people, they do this kind of modeling certainly, but what they really look at are scenarios. They consider different scenarios in which, and they decide how they will act in those scenarios. Anyway, that is one. On the point you made, and I think radicals who about this coordinated dumping of US treasuries by some countries. As you know, and she also mentioned, I mean, when you dump your your holding of treasuries and bring it down, the value of the treasury, you're also losing your wealth. So, but in fact, because there was an article that was circulating, which I think you're referring to, we examined this very carefully. And I followed this up with, because Japan also is a big holder of these things. I didn't have anybody directly to talk to in China. But because the story was that it was in fact being led by the Prime Minister of Canada, who was a former central banker of 2 countries and a very, very bad guy, that he had thought up this way of doing it, that if there's a coordinated thing, and this will teach a lesson to Trump. He also had a big meeting with Trump, if you remember. So this looked like a credible story, but we checked this out. It close fact checking. And in fact, this did not happen. There was no coordinated, dumping of treasury holdings by the sovereigns of these countries. But I think a lot of private hedge funds and so on did drop. And that was good enough to teach Trump a lesson that, you can't just get away with anything that you...
Government holdings of treasuries prior to Trump's
That has been happening gradually for a long time as a part of diversification. I mean, and this is not with Trump, even before. In fact, when it comes to China, it's a very interesting story because I don't know how much Trump even understands about this, but those guys play for the long game. He was talking about, and they have been, actually their aim is to really dismantle the system that was set up, not during Bretton Woods, but it happened in the 1920s when the United Kingdom, the sterling used to be the holding currency, it shifted to dollar. It happened between the two world wars. And since then, the dollar has been dominant. And the Chinese clearly have an agenda of displacing the dollar and the SWIFT system, which is all dollar-based. In fact, there was another story circulating that they had introduced their own alternate system where you clear holdings in renminbi. And all the ASEAN countries are part of this, and also a number of the Middle Eastern countries. And this thing has been confirmed. This is happening now. Initially, the media was not picking it up, but now they are picking it up. So the Chinese are aiming at something much bigger, as you were kind of implying. That is a complete change in the sort of global financial system that we are used to. So all our past models and so on will become, they're already obsolete and become completely obsolete. We have to rethink all this very carefully. A little comment on what you mentioned. By the way, you were asking about, just coordinate with Rudani if you want the PowerPoint. He's a colleague from Mint. On the CapEx question, there are three ways of interpreting the question you ask. One is that have we reached a limit because of very high CapEx investments ever since this government came in, year after year after year? Have we reached the limits of our absorptive capacity in order to handle this scale of? I don't think this was really the question you were asking. I think you were asking more about a fiscal question. But it is a real question on the real side, that how much of rapid growth of roads, investment by Mr. Gadkari and building of airport, how much can the Indian system actually handle? And maybe we are not far from the limits on where that is concerned. But I don't think your question was really about the fiscal capacity. And here, partly the answer also, relates to the question that you were asking. That one of the, there are two parts to this answer. One is that even without the new framework, even in the old framework, you can, there's a lot of flab in the expenditure of the government in terms of unwarranted subsidies, huge giveaways in terms of what we call tax expenditure, meaning, concessions or exemptions of taxes and so on. So there's a lot of headroom to do some of reallocation of both spending and removal of, we call it tax, actually, removing some of the exemptions, which would create quite a bit of space if you really want to push up your capex, because that is compromising your growth. But a more important or another aspect of this is this shift. The finance minister didn't even mention it in a budget speech. And it is buried away in one of the obscure documents and so on, and the government has not focused on it at all. Media has not picked this up at all. But it's a huge change in your fiscal consolidation framework from looking at the FD GDP ratio to the FD debt ratio. The debt to GDP ratio. Now, if you think about it, your debt stock is a huge thing where, as he mentioned, that, your debt is all denominated in what price levels was there in the past. If you take it, the new borrowing, the new fiscal deficit, only a small delta at the edge of this. So even if you don't, so long as your nominal GDP is growing at a faster rate, normally it's been growing at 14, 15%, now maybe 11, 12% with interest come down. The debt stock never changes, at that pace, because the fiscal is a minor addition at the edge of a huge stock. So, in fact, it was quite deliberate, I think, to get themselves greater flexibility and become less, fiscal fundamentalists, that the finance ministry, they're very bright people, that they consciously did this. and did not want to draw much attention to this. It's given them huge fiscal space to do a whole lot of things without really jeopardizing the debt sustainability question. Why is all this important? If you forget illogical things about FD being bad and so on, I mean, last day was the Washington consensus. The real issue is that if your debt servicing keeps going high, and it's about 25% right now in for a central government, it crowds out spending on better things like developer expenditure, education, health. That's really what matters. Now, so long as your nominal GDP is growing faster than the growth in your debt GDP, there is no problem. And this thing is never seriously addressed, by all our fiscal experts and macro guys. I mean, people like Keynes and the Keynesians and Cambridge and all are well aware of this. But then they lost out in the game vis-a-vis the other schools of thought. And so that's why we have come to this pass. But these bright mandarins in finance ministry have understood it, quietly done this. Thank you.
Hi, my name is Arshim. I work here. I have a question for Radhika ma'am. So regarding the impact of tariffs on FDI, so it also depends on how we respond to that tariff. If we do the monetary policy versus fiscal policy, they have opposite effects on the interest rate. And hence it will have opposite effect on the FDI, which will come chasing that interest rate. Is that correct?
I have two questions. I'm Amarnath from NIPF. I have two questions, one related to CapEx, one related to debt. At state level, they have very little room for capital expenditure for the various reasons that they have a lot of populist expenditure. Also, they have compulsory expenditure on centrally sponsored schemes. They are left with limited resources, and their fiscal deficit is again constrained. When it comes to the central government CapEx, there is a lot of capital expenditure which is being routed outside the consolidated fund. You yourself mentioned about the roads expenditure. The cess money gets into another fund which is outside consolidated fund, and from there so when you take only budget numbers of the CapEx, maybe it is an underestimation. And second thing is that we are talking about growth, year-on-year growth. It grew by some 30%. Now it is growing only by 19%. But even if it has grown at 19%, it may be at the same level as it was growing at, because suddenly we saw a huge jump in capital expenditure by the central government by giving additional borrowing to the states and all that. Now they are maintaining at same level. So maybe growth is not a right thing. We should have considered it as a level of a GDP. This is one of my observations. Second is about debt. About center, I will not say anything, but when it comes to the states, there are some states which are having debt GSDP ratio which is higher than the limit that has been prescribed. And there are some states which are very comfortable. The moment you move away from the fiscal deficit as one of the targets to the debt GDP ratio, GSDP ratio, if the states which are having debt GSDP ratio lesser than the norm, and if they start borrowing, at aggregate level, we may go outside our 50% limit or 60% limit. So how do we address that issue? These are the two.
So you were talking about the impact of interest rate on FDI. I know, yes. So what I'm trying to say here is that interest rates are not a major determinant of FDI. It's mainly the long-term relation, cost of doing business, ease of doing business, logistics, because FDI is a long-term relationship. So it's not just impacted by a cut in the repo rates. And it's the bond yields differential matters for FPI, foreign portfolio investments in bonds. So we don't have a very direct relation of the impact of tariff on FDI through our monetary policy response. So that's it.
So if you look at the center and states, traditionally the CapEx, most of it was done by the states. It's only after COVID, in order to revive growth, that the central government stepped in. And increase the capital expenditure. So what we are now talking is the year-on-year growth. So although the level is there, remains same, but then there has not been a growth. Your revenues are increasing, your expenditures are increasing, but to meet the deficit, you are not increasing capex as you've been doing in the past. And moreover, as far as various funds that are being there, which goes outside the various capex expenditure that happens outside the budget, that is not being captured by us in any of the years in this analysis. So that is there, but on the revenue side, through cession and surcharges, your overall revenues increase. So the growth in cessions and surcharges shows in your revenue expenditure. But then if you are parking them in some various kinds of funds that you have created to carry out those expenditure, will be captured in those funds, how say road cess is being used or how education cess is being used. So that is not being captured, but just revenue side, if you show there is an increase which gave them more legroom to increase their capital expenditure. As far as debt is concerned, as of now, I think it is even in the fiscal deficits, which continues to be the anchor at the state level, you find it varies from 8.5% to minus to 2% or 1% in, so that variation is there. But then when annual borrowing ceiling is decided by the central government, every year when they give you a limit as how much you can borrow, probably that would, through that channel, that you can control the debt. And as of now, states have not moved into this debt GDP ratio anchor. They continue to go through the FD GDP.
So the question was basically, I mean, I think sir can answer it. There are some states which are already having high debt GSDP ratios. Now, the moment we move to this debt GDP ratio as one of the fiscal constraints, the states which are already there, where their fiscal debt GDP ratio is low, they will start borrowing more. And the states which are already having high, they will not be able to contain that within a short period of time. So the overall debt GDP ratio across all the states, aggregated debt GDP ratio of the states will increase in short term.
No, even if you look at on the deficit side, you have 3% borrowing limit, but many states who are fiscally prudent like Odisha and others, they are not even borrowing up to that level limit also. They are not fully utilizing the limit. So there is no reason to believe that when you fix the debt GDP ratio, they will start borrowing more, because even given the current situation, they are not doing in the current regime also.
Just a couple of comments to supplement what Manish said. First of all, as you mentioned, the states as also the center engage in a lot of unnecessary spending because they are populist. You mentioned that. Now, those are not committed expenditure in the sense of like, salary and they can easily cut back. They don't do it for political reasons. So there's already headroom over there, number one. Number two, every state FRBM also specifies what is the limit for the contingent liability, which is the off-budget borrowing you're talking about. And they are required to stay within that off-budget borrowing. So it won't be reflected in the budget, but it gets reflected in this larger, the cap on the larger thing. And there are some states who have been pushing that limit. Kerala is one of them. Needs to be closely associated, and with one of these entities which borrows in fact the road cess, the tax on vehicle registration would be given to this organization called KIFBI, Kerala Infrastructure Financial thing. And they kept on doing it, and I would, every meeting, board meeting I would chair, I will ask them what is happening vis-a-vis that. They no, no, we are okay, and so on, and finally I left. And I think they are now in deep trouble because the Auditor General has raised it, and this matter is in court now. So there are limits. I mean, any state can breach it, and some fiscally very irresponsible states which are, I mean, the obvious suspects, Punjab, Kerala, West Bengal, another case. The third thing I wanted to say is that, this shift from fiscal deficit debt GDP, first of all, has not been done in the states as yet. But even in the center, they have just done it, as a executive decision. They have to actually change the Central FRBM Act, because the Central FRBM Act is all defined in terms of the, the earlier fiscal deficit to GDP ratio. So that has to be done. And when that is done, I'm sure the states will, also have their own FRBM Acts which will be revised and some of that. So that's work that's pending, that needs to be done. So let's see how we proceed on that. But it does, one thing is very clear, that they've added a great deal of flexibility. What Keynesian referred to as fiscal fundamentalism has really been given up by shifting to the debt GDP ratio. Stop there.
In fact, the Encasing Committee, FRBM Review Committee recommended moving to debt GDP as the anchor, and then they had given a path of bringing the glide path of bringing the state debt to 20% and center to 40% and general government debt to 60%. So that recommendations, I think they are now. They have accepted that committee's report, but I think it is now being implemented.
I think we've had a very interesting and stimulating discussion. So thank you very much for all being here. Particular thanks to Professor Kar for taking the time and for sort of drawing the attention back to the medium term and the long term, which I think is very critical elements, because when we are not looking at status quo, then we need to be looking at the medium and the long term. We will, I guess, have more turbulence in the next 3 months, but thereafter, hopefully things will start taking shape as to what the new world looks like. There was one statement, one comparison. We should, Radhika, at one point you said we should reduce our trade deficits with the US. Yeah, but the question remains, even after you reduce your deficit, there's no assurance that the tariffs will go down. So they're a negotiating point more than an action point. But anyway, it was very interesting. So thank you very much.